Did you know that 78% of Americans live paycheck to paycheck? Shocking, right? Or that nearly 40% of US adults can't cover a $400 emergency expense. These numbers show how common it is to struggle financially. But why does this happen to so many people? In this video, we'll uncover 21 surprising money habits that might be keeping you poor. We'll dig into things like impulse buying, living on credit, and avoiding investments. You'll learn strategies to break these habits and start building real wealth, ready to transform your financial future. So let's dive in and discover the hidden traps that could be draining your wallet. Stay tuned, because understanding these habits is the first step to escaping them. Impulse splurging, the silent wealth killer. Impulse splurging is one of the sneakiest ways to drain your bank account. Every little purchase adds up. Did you know that Americans spend an average of $400 annually on impulse buys? That's according to a survey by Slick Deals. One way to curb this habit is to implement a 24-hour rule. If you see something you want, wait 24 hours before buying it. Often the desire will pass. Another strategy is to shop with a list and stick to it. This can help you avoid unnecessary items. It's also wise to avoid shopping when you're emotional. Many people shop to cope with stress or sadness, but this can lead to regretful purchases. Instead, find healthier ways to manage your emotions, like exercising or talking to a friend. Remember, it's not about depriving yourself, but about making mindful choices. As financial expert Dave Ramsey says, you must gain control over your money or the lack of it will forever control you. To credit card chaos, living beyond your means. Credit cards can be a useful tool, but they can also lead to financial chaos if not managed properly. The average American household has $694 in credit card debt, according to Experian. To avoid this, only charge what you can pay off in full each month. This prevents interest from piling up. Set a limit on your card that's lower than your actual credit limit. This can help you stay within budget. Also, avoid using credit cards for everyday purchases like groceries or gas. Instead, use cash or a debit card. This makes it easier to keep track of your spending. Remember to check your statements regularly for any unauthorized charges. As Warren Buffett wisely said, do not save what is left after spending. Instead, spend what is left after saving. Saving sabotage, ignoring emergency funds. Ignoring the need for an emergency fund is a major financial mistake. An emergency fund acts as a financial safety net. According to Bankrate, 28% of Americans have no emergency savings. Ideally, you should have 3 to 6 months worth of expenses saved. Start by setting a small goal like $500 and gradually increase it. Automate your savings by setting up a monthly transfer from your checking to your savings account. This makes saving effortless. It's also crucial to keep your emergency fund in a separate, easily accessible account. This way, you're not tempted to dip into it for non-emergencies. As financial author Suze Orman advises, emergency funds are like a glass of water on a hot day. You may not always need it, but you'll be glad it's there when you do. Subscription slumber, wasting money on unused services. Subscriptions can quickly become a hidden financial drain. On average, people spend $237.33 per month on subscriptions, as reported by West Monroe. Many of these go unused. To combat this, review your subscriptions regularly. Cancel any that you don't use or need. Consider using a subscription management app to keep track of all your services. Another tip is to negotiate your subscription rates. Many companies offer discounts if you ask. You can also share subscriptions with family or friends to cut costs. Remember, every little bit saved adds up. As author Thomas Stanley wrote, it's easier to accumulate wealth if you don't live in a high-status neighborhood. Retail therapy, emotional spending pitfalls. Retail therapy might make you feel better temporarily, but it can harm your finances. According to a study by TNS Global, 52% of Americans have shopped to improve their mood. Instead of shopping, find alternative ways to boost your mood. Exercise, meditation, or hobbies can be great alternatives. If you must shop, set a strict budget and stick to it. Avoid shopping during emotional highs and lows. It's also helpful to recognize your triggers. Knowing what drives you to spend can help you avoid these situations. As Gretchen Rubin, author of The Happiness Project, says, spend out means enjoying what we have instead of craving more. Debt denial, the cost of ignoring loans. Ignoring debt can lead to serious financial consequences. According to the Federal Reserve, the average American household has 137,063 in debt. It's crucial to face your debt head-on. Start by listing all your debts, including the interest rates and minimum payments. This gives you a clear picture of what you owe. Then choose a repayment strategy. The snowball method, where you pay off the smallest debt first, can provide quick wins and motivation. Alternatively, the avalanche method focuses on paying off the highest interest debt first, saving you money in the long run. Set up automatic payments to ensure you never miss a due date. As financial advisor Rick Edelman says, the most powerful force in the universe is compound interest, but it can work against you if you're in debt. 7. Budget blindness. Living without a financial plan. Living without a budget is like driving without a map. You might get somewhere, but it probably won't be where you want to go. According to a survey by US Bank, only 41% of Americans use a budget. To start, track your expenses for a month to see where your money goes. Then create categories for your spending and set limits for each. Use budgeting tools or apps to make the process easier. It's important to review and adjust your budget regularly. Life changes, and so should your budget. Remember, a budget isn't about restriction, it's about freedom. It gives you control over your money and helps you achieve your financial goals. As financial expert Dave Ramsey puts it, a budget is telling your money where to go instead of wondering where it went. To investment ignorance, fearing the stock market. Many people avoid investing because they fear the stock market. This fear can cost you significant wealth over time. According to Gallup, only 55% of Americans invest in stocks. However, investing is one of the best ways to grow your money. Start by educating yourself about the basics. Books like The Intelligent Investor by Benjamin Graham offer great insights. Consider starting with a low-cost index fund, which diversifies your investments and reduces risk. You don't need a lot of money to begin. Even small, regular investments can grow over time. Use robo-advisors or financial apps to simplify the process. Remember, it's about time in the market, not timing the market. As Warren Buffett advises, the stock market is designed to transfer money from the active to the patient. 9. Luxury lifestyle. Pretending to be rich. Living a luxury lifestyle you can't afford is a fast track to financial trouble. According to a report by Credit Suisse, the top 10% of global wealth holders own 84% of the world's wealth. It's tempting to keep up with this lifestyle, but it's important to live within your means. Create a budget that reflects your actual income, not what you wish you earned. Avoid buying luxury items on credit. Instead, save up for these purchases. Remember, true wealth is built over time, not through flashy displays. Focus on long-term financial goals rather than short-term gratification. As Robert Kiyosaki, author of Rich Dad, Poor Dad, says, the rich buy assets, the poor only have expenses, the middle class buy liabilities they think are assets. 10. Financial illiteracy, avoiding money education. Avoiding financial education can leave you in the dark about managing your money. A survey by the National Financial Educators Council found that lack of personal finance knowledge costs Americans an average of $1,279 per year. Take the time to learn about budgeting, saving, and investing. There are countless free resources available, from books to online courses. Your Money or Your Life by Vicki Robin and Joe Dominguez is a great start. Attend financial workshops or webinars. The more you know, the better decisions you can make. Remember, financial literacy is a lifelong journey. As Benjamin Franklin said, an investment in knowledge pays the best interest. 11. Gambling gaffes, risking it all for quick cash. Gambling can be a dangerous habit, often leading to financial ruin. The National Council on Problem Gambling reports that around 2 million U.S. adults have a severe gambling problem. Instead of gambling, look for safer ways to grow your wealth. Investing in stocks or real estate can provide better returns with less risk. If you enjoy the thrill, consider investing a small fixed amount in a speculative stock. But don't bet more than you can afford to lose. Set strict limits on your gambling activities. Remember, wealth building is a marathon, not a sprint. As Peter Lynch, a famous investor, said, know what you own and know why you own it. 12. Neglecting negotiation, paying full price. Failing to negotiate can cost you significant money over time. According to a survey by CareerBuilder, 56% of workers do not negotiate for better pay. This same principle applies to everyday purchases. Always ask if there are discounts available. You'd be surprised how often you can get a better deal just by asking. Compare prices online before making big purchases. Use apps that alert you to price drops. If you're uncomfortable negotiating, practice with small purchases first. Remember, every dollar saved is a dollar earned. As the author of Secrets of Power Negotiating, Roger Dawson says, you should always try to negotiate for a better deal. It's the best way to save money. 3. Overlooked opportunities, missing out on side hustles. Not taking advantage of side hustles can be a missed opportunity for additional income. According to a study by Bankrate, nearly half of working Americans have a side hustle. Identify your skills and interests to find a suitable side gig. This could be freelancing, tutoring, or even selling handmade goods. Platforms like Fiverr, Upwork, or Etsy can help you get started. Even a few extra hours a week can make a difference. Invest this additional income wisely. Use it to pay off debt or add to your savings. Side hustles can also offer new learning opportunities and career growth. As Chris Guillebeau, author of Side Hustle, says, a side hustle is more than just an extra source of income. It's a gateway to empowerment and financial freedom. 14. Impulse investing. Chasing hot tips. Chasing hot investment tips can lead to significant losses. The stock market is unpredictable, and following the latest trend often results in buying high and selling low. According to a study by Dalbar, the average investor earns significantly less than the market average due to poor investment decisions. Instead, focus on long-term investments based on thorough research. Diversify your portfolio to spread risk. Avoid making decisions based on emotions or market noise. Remember, investing is about patience and strategy. As John C. Bogle, founder of Vanguard Group, said, don't look for the needle in the haystack, just buy the haystack. 15. Lifestyle creep. Spending more with higher income. Lifestyle creep happens when your spending increases as your income goes up. According to the Bureau of Economic Analysis, personal consumption expenditures in the U.S. increased by 4% annually from 2015 to 2019. To combat this, stick to your original budget even when you get a raise. Allocate the extra income towards savings, investments, or paying off debt. Keep your living expenses consistent and avoid the temptation to upgrade your lifestyle. Regularly review your financial goals to stay focused. Remember, it's not how much you earn, but how much you keep. As Thomas J. Stanley wrote in The Millionaire Next Door, wealth is more often the result of a lifestyle of hard work, perseverance, planning, and most of all, self-discipline. 16. Lack of goals. Drifting without financial direction. Not having clear financial goals can leave you adrift. According to a study by TD Ameritrade, 58% of Americans don't have a retirement plan. Start by setting specific, measurable, achievable, relevant, and time-bound, SMART goals. Write down your goals and review them regularly. Break them into short-term, medium-term, and long-term objectives. This can include saving for an emergency fund, paying off debt, or investing for retirement. Use tools and apps to track your progress. Adjust your plan as needed to stay on track. Goals provide direction and motivation. As Zig Ziglar said, a goal properly set is halfway reached. 17. Ignoring inflation. Underestimating future cost. Ignoring inflation can erode your purchasing power over time. According to the U.S. Bureau of Labor Statistics, the average inflation rate over the past decade was about 1.8% per year. To protect your wealth, invest in assets that outpace inflation, such as stocks or real estate. Consider inflation-protected securities like Treasury inflation-protected securities. Tips: regularly review and adjust your investment portfolio. Factor inflation into your long-term financial planning. 18. Stagnant savings. Keeping cash idle. Keeping your savings idle in a low-interest account can result in missed opportunities for growth. According to the FDIC, the national average interest rate for savings accounts is just 0.05%. Instead, consider high-yield savings accounts, which offer better returns. Look into certificates of deposit, CDs, or money market accounts. Diversify your savings into investments like stocks, bonds, or mutual funds. Frugality fallacies. Being cheap instead of smart. Being cheap can sometimes cost you more in the long run. According to a study by the Harris Poll, 70% of Americans regret buying cheap products. Focus on value, not just price. Invest in quality items that last longer and provide better performance. This applies to everything from clothing to electronics to household items. Look for discounts and deals on high-quality products. Avoid the trap of false economy, where short-term savings lead to higher long-term costs. 10. Procrastination penalties. Delaying financial decisions. Procrastination can lead to missed financial opportunities. A survey by NerdWallet found that procrastination costs Americans about $300 billion annually in lost productivity. Start by setting deadlines for your financial tasks. Break big tasks into smaller, manageable steps. Use reminders and alerts to stay on track. Seek professional advice if needed to make informed decisions. Remember, the best time to act is now. 21. Tech temptations. Overspending on gadgets. Overspending on the latest gadgets can quickly drain your finances. According to a survey by Deloitte, Americans spend an average of $1,200 annually on electronics. Before buying, ask yourself if you really need the latest model. Compare prices and look for deals. Consider buying refurbished or older models. Set a budget for tech spending and stick to it. Avoid the hype and focus on what adds real value to your life. Remember, gadgets depreciate quickly.